All right, Walter Wofford back, short-term rental cash flow roadmap. Got another topic today, and as you know, if you've been watching the videos, when we acquire properties for short-term rentals, my two favorite way is to negotiate seller financing or buying it subject to the mortgage, leaving the mortgage in place, and we just take over the payments. But we have a problem. Many times we have a problem. It takes some real cash to pay the equity or the down payment, whichever. If equity, if it's subject to, or the down payment if it's seller financing. What if you got to come up with $40,000 to purchase the property? So in this video, we're going to explore different ways to do that, and you're going to learn something, and you probably are going to apply it. All right, let's take a look.
Ready to really build that real estate portfolio, right? Focusing on short-term rentals, the STR market, because it's booming.
Yeah.
But then you hit that wall. The huge down payments banks want. It's daunting. Makes you feel kind of stuck, doesn't it?
Yeah.
So this deep dive, it's built for you. We're going to cut through all that noise, the endless articles, the advice pulling you every which way. We're aiming straight for the good stuff, the actionable insights from the sources you shared. Our goal today, give you the tools, the knowledge to make those big moves without the usual bank headaches.
Exactly. The mission here is really to demystify some of these creative financing strategies, shine a light on practical ways you can actually fund that down payment, even when it seems, intimidating. Ultimately, we want you to be able to unlock deals others might just walk away from just because they don't know these options exist.
And really, this isn't just going to be us listing terms. There are some genuine aha moments coming up. Surprising fact strategies you can actually use. You should walk away feeling not just informed, but like really empowered to build or expand that STR empire. Okay, so let's unpack this. We should probably start with the foundations, right? These two core creative strategies, subject to and seller financing. They're absolute game changers, really powerful tools.
Yeah, let's dive into subject to first. It's short for subject to the existing mortgage. So what that means is you, the buyer, you take ownership, you start making the mortgage payments, paying the taxes, insurance, all that. But here's the kicker, the really interesting part. The original mortgage, it stays in the seller's name.
Stays in their name.
Yeah. You don't formally assume the loan with their bank. The title transfers to you, but it's subject to that existing loan.
Okay, that sounds almost too good to be true. What's the catch? Or maybe, what's the trickiest part people run into with that?
That's a really good question, and it brings up one of those aha moments, actually. A lot of people immediately worry about the due on sale clause. Technically, the lender can call the loan due when ownership changes.
Right, I've heard of that.
But here's the surprising bit. Based on, decades of how this plays out in real estate, lenders very rarely enforce it, especially if the payments are coming in on time consistently. Think about it. Their main goal is getting paid. Forcing a foreclosure. That costs them time, money. It's a hassle.
So it's a risk, but maybe not as big a practical risk as it sounds.
Exactly. As long as the property's managed well and payments are smooth, the practical risk is often pretty low. And the other benefits, they're compelling. First, hardly any qualification needed, no credit check, no income verification, no bank hoops to jump through.
Wow.
Second, speed. These deals can close super fast, like in days sometimes.
Days, not months.
Potentially days, yeah. And third, your upfront cash is usually way lower. Often you just need to cover the seller's equity plus closing costs. So, quick example. Property's worth $200,000. Seller owes $140,000.
Cool.
You might pay them, say, $20,000 for their equity. Then you just take over those $140,000 mortgage payments. So effectively, you got the house for $160,000 plus your closing and setup costs.
That completely changes the game compared to a traditional 20% down loan. Makes it way more accessible. All right, let's pivot then. Seller financing. That's the other big one.
Right.
Here, the seller actually acts as the bank. Is that right? You pay them directly.
Exactly. Instead of getting a bank loan, you make payments straight to the seller over time, based on terms you both agree on.
Okay, but why would a seller want to do that? Seems like they're taking on risk.
They are, but it's often a win-win, seriously.
Right.
For the seller, they get a steady income stream. Sometimes they can defer capital gains taxes, spread them out. Plus, they might sell their property faster, maybe for a better price, without worrying about a buyer's bank financing falling through.
Oh, okay. Avoids appraisal issues and stuff, too.
Precisely. And for you, the buyer, huge benefits. Flexibility is key. You can customize interest rates, payment schedules, how long the loan lasts, all negotiable. And it's way more accessible if your credit isn't perfect because, again, no traditional bank qualifications.
So let's say you agree on a $250,000 price. The seller might finance, what, $225,000? Maybe over 15 years at 6%?
Could be, yeah. Whatever terms you negotiate.
And you just send them a check each month, completely bypassing banks.
Pretty much. It sounds like these creative methods really level the playing field, huh? They absolutely do. Both subject to and seller financing can really streamline getting into a property. But here's the thing. Even with these methods, you're probably still going to need some cash up front.
Right. For the seller's equity in a sub-2, or maybe a down payment and seller financing, plus closing costs.
Exactly. And that brings us right to the next big challenge we need to tackle. How do you actually fund that chunk of cash?
And that is what we're diving into right now. This is the real meat of it. 7 effective strategies to get that crucial money together. Think of these as your creative toolkit for funding those STR deals.
Let's walk through them because this is often where people find those missing pieces for their funding puzzle. Strategy 1, pretty straightforward if you're already in the game. Use cash flow from your existing STRs.
Okay.
Simple idea, but powerful. You basically allocate a slice of your profits from current rentals into a separate savings account just for down payments. You could even use tools like RelayFi to automate it, maybe use a profit-first approach, ensure you're consistently putting money aside each month for the next deal.
Right, paying yourself first, but specifically for growth. Makes sense.
What?
What's number 2?
Second, think about borrowing from private lenders or even joint venture partners. This opens up a whole network. Could be friends, family who want a decent passive return, could be actual private lenders who specialize in real estate, or even people with self-directed IRAs looking for secured investments.
Interesting. How do you structure that, though, especially with, friends or family? Feels tricky.
Good point. The absolute key is a clear, written agreement. No handshakes. You'd typically use things like secured promissory notes, maybe an assignment of rents agreement, we'll touch on that more in a sec, where you pledge future income from the property as collateral.
Okay, so it's formal.
Very. Say you borrow $25,000 at 10% interest. You secure it with a second mortgage on the new property, maybe agree to pay it back over 3 years using the STR income. Transparency and a clear repayment plan are crucial. And that leads right into the third strategy. Using an assignment of rents agreement, maybe even as a standalone thing. This works especially well if the new STR will start making money right away. You basically promise or assign a percentage of the future rent, maybe 15%, directly to repay that specific loan until it's paid off.
So you're not giving up equity, just carving out a piece of the income temporarily to cover that specific debt for properties that cash flow fast.
Exactly. Okay, fourth strategy, and this one's more for experienced investors. 0% interest credit cards.
Ah, the intro offers.
Yeah, those promotional 0% APR cards. They can be a short-term bridge for things like furnishings, maybe even a small bit of the down payment. Now, the crucial part here, another aha moment maybe, it's not just about avoiding interest. It's about understanding how to strategically use that 0% period as essentially free short-term capital. Timing is everything.
But you have to pay it off before that promo ends.
Absolutely. You need a rock-solid plan to clear that balance before the regular, usually very high interest kicks in. Discipline is key.
Okay, makes sense. Risky if you're not careful. What about bringing in other people?
Yep. Number 5. Bring in a silent equity partner. This is someone who puts up the down payment cash in return. They get a piece of the action, a share of the ongoing cash flow, and a cut when the property eventually sells or appreciates.
So they provide the capital, you provide the sweat equity, the management.
Exactly. You run the STR day to day. They get a passive return. It's a great way to scale if you're strong on the operational side, but maybe lighter on cash.
That does sound powerful for scaling. What's next?
6th. If you already own property, maybe your primary home, another rental, and it has equity built up, you can tap that equity using an HELOC or a cash-out refinance.
Right, a home equity line of credit or refinancing to pull cash out.
Yeah, it turns that locked-up equity into cash you can actually use for your next STR purchase. And finally, number 7, crowdfunding from micro-investors.
Okay, like using online platforms or just your own network.
Both. You gather smaller amounts of money from a larger number of people. The key here is having a really clear, compelling pitch. You got to lay out the deal structure, what returns they can expect, and critically, what the exit strategy is for their investment. How and when do they get their money back, plus profit.
So lots of options there. But okay, what does this actually look like when you put it all together? How do these pieces fit in a real deal? Let's make this concrete. Walk us through an example combining these.
Perfect. Let's use that subject to scenario again and see how we fund the cash needed. Remember the numbers. Property value, $200,000. Existing mortgage, $140,000.
Okay.
So you need $20,000 for the seller's equity. Let's add $5,000 for closing costs, fees, that kind of stuff. And then maybe $15,000 for furnishings, setup, getting it ready for guests.
Got it. So 20K plus 5K plus 15K, that's $40,000 total cash needed.
Right. $40,000.
Okay, 40K. Feels like a hurdle. But using these strategies we just talked about, how do we build that stack? Where does the first chunk come from?
Well, let's start with strategy 1. Maybe you already have some STRs running. We'll allocate $10,000 from STR profit savings. Maybe you manage to save, say, $2,500 a month for the last 4 months from your other operations. That's our base.
Okay, 10K down, 30K to go. What's next for the biggest piece?
For the big piece, $20,000, we use strategy 2. We get a private lender loan. Let's say we find someone willing to lend at 12% interest, secured by a second mortgage on this new property, with maybe a 24-month payback term. That's our main funding source here.
All right, private loan for $20. That gets us to $30,000 total. Still need $10,000 more. How do we bridge that final gap?
Okay, for $5,000, we use strategy 3, an assignment of rents agreement. We pledge 15% of the new property's monthly income until that $5 is paid off.
Clever. Using the asset's own future income.
Exactly. And the final $5,000, we use strategy 4, a 0% APR business credit card. We use that specifically for buying the furniture, initial supplies. And we have a strict plan to pay that 5K off within, say, 12 months before the interest hits.
And boom, there's the $40,000. A mosaic, like you said. $10 savings, 20K private loan, 5K assignment of rents, $5K credit card.
Precisely.
Okay, but how does the repayment look? Let's assume the place cash flow is about $2,000 a month after the main operating costs, mortgage payment, taxes, insurance.
Good question. So that $20,000 private loan at 12% over 24 months, payments would be around $950 a month, principal and interest.
Okay.
The assignment of rents, taking 15% of that $2,000 cash flow, that's $300 a month going towards paying off that $5,000, should take about 17, 18 months. And the credit card, that $5,000. To pay it off in 12 months, you'd need to pay about $420, $450 a month. Let's say $450 to be safe.
So $950 plus $300 plus $450. That's $1,700 a month, just servicing the funding for the down payment and setup out of $2,000 cash flow. Tight, but doable.
It is. And crucially, beyond those debt payments, you must plan for reserves. Don't forget that. We'd absolutely recommend setting aside money every month, maybe $300 a month into a maintenance reserve for repairs, and another $200 a month for future big stuff capital expenditures like a new roof someday or appliances.
Right, got to protect the asset and the income stream.
Exactly. What's really fascinating here, though, is seeing how you can layer these different sources. Stacking them up strategically makes a deal possible that just wouldn't fly with traditional financing.
Okay, this sounds incredibly powerful.
Okay.
But let's be real. With great opportunity comes, well, responsibility, right?
Absolutely.
These creative strategies aren't without risks. It's super important for you, the listener, to understand what you're getting into. Let's unpack those risks.
Definitely. The first big one, especially with subject to, is that due on sale clause we talked about earlier.
Right. The lender could technically call the loan due.
They could. The loan documents give them that right when the title transfers, but like we said, context is key. The practical risk is often low if the payments are made like clockwork and the property's kept up. Lenders generally prefer getting checks over starting foreclosure proceedings, but you need to know that risk exists technically.
Okay. Good to reiterate. What else?
Second, you have to factor in market fluctuations. STR income isn't guaranteed or stable like a long-term lease might be.
Seasonality.
Seasonality, big time. Also, broader economic shifts, recessions impacting travel, that sort of thing. And just plain old local competition popping up. Your income projections need to be conservative and account for potential dips.
Don't count your chickens before they hatch, basically.
Keep much. And third, maybe the most direct risk, operational execution. Simply put, if you don't manage the property well, bad guest reviews, cleaning issues, poor marketing, slow response times, your income will suffer.
And that directly impacts your ability to make all those payments we just outlined.
Exactly. It all ties together, which naturally raises the question, how do you manage these risks? How do smart investors handle this stuff? It really boils down to planning for these things from day one.
That's a really crucial point to end on. So let's wrap this up. The core message today is pretty clear, I think. Creative strategies like subject to, like seller financing. When you combine them with these kinds of smart, layered funding approaches, they are incredibly powerful tools. They let you build that STR portfolio without necessarily needing the massive down payments and hoops of traditional banks.
Yeah, to sum it up, you combine these acquisition methods with smart funding, tapping existing profits, finding private money, using creative structures like assignment of rents. Suddenly, you can unlock deals that most people, frankly, would just overlook. You start seeing opportunity where others just see roadblocks. And if you connect that to the bigger picture, well, it dramatically expands your potential playing field in real estate investment, goes way beyond the conventional path.
And that's really what we want to leave you with today, that next big down payment you need for an STR. It might be far more achievable than you thought. It takes work, yes. Proper risk management, solid financial planning, and you absolutely need to commit to running the property well, operational excellence. But the path is there. So we really encourage you, think about your own resources, your network, your skills. How could you leverage them for your next opportunity? The power, honestly, is in your hands to make those strategic moves.